I think deterministic, actions are important. And once you have determinism in your technology, all of a sudden, latency becomes more and more important ultimately, because that helps you reduce the uncertainty. Right? And I think, at least the way I think about things a lot is, what can we do to reduce uncertainty? Whether or not it's risk management, operations tech. And so there is inherent value in being able to move quicker, move in real time, because there's less uncertainty. And so when I first saw these estimates of sub-millisecond latencies, I kind of scoffed at it, but quickly you realize part of the value in improved performance is reducing that uncertainty. And anytime there's a technological leap that helps do so, it will get quickly adopted. And so what is latency sensitive today is very different than what was latency sensitive 15 years ago. And so I kind of think about it the same way in the crypto space. Now there's the common chorus of, well, these are internet-based or cloud-based platforms, so you're dealing with some of the latencies associated with that. But every time technology improves to enable better performance, the market will adopt it. That's just the way it's going to work.
Hello and welcome to another episode of RULEMATCH Spot On, the only podcast focused exclusively on the institutional crypto and digital asset industry. I'm your host, Ian Simpson, and if you want to know what banks, securities firms, active trading firms, hedge funds, and others are doing in crypto and digital assets and how they're doing it, this is the place for you. And now to our guest, Chris Zuehlke. Chris is a partner at DRW and global head of Cumberland, the crypto subsidiary of DRW. For any of our listeners who don't know DRW, it is one of the world's premier electronic trading firms in traditional markets and also in crypto markets, with offices from Montreal to Singapore, from Tel Aviv to London, and its headquarters in Chicago. Chris graduated from the University of Illinois, just down the road from my hometown of Indianapolis, with a degree in computer science and mathematics, where he also focused on AI and cognitive sciences. He joins us from Chicago in the studio here in Zurich today. And of course, before we get started, we should mention that nothing which we discuss today should be considered financial advice. Chris, thanks for joining us and welcome to RULEMATCH Spot On.
Thanks, Ian. It's a pleasure to be here.
Chris, you've been a frequent guest on CNBC, which is probably almost as fun as being on RULEMATCH Spot On today, and commenting on market movements. We won't get into any price action or things like that today, but it'd be interesting to start out just getting your feedback on where markets are and specifically how healthy the crypto market is. Maybe put another way, how resilient the crypto market is. We know things go up and down, cycles in crypto are quite violent sometimes. How healthy is the crypto market today?
Yeah, I'm certainly more healthy than 10 years ago from a resiliency perspective. And typically people look at things like price action as an indication of resiliency, arguing that big gaps are indicative of lack of resiliency, lack of liquidity. But what I think is important to understand is you kind of got to look past the surface layer and understand the underlying structures in the market to identify that resiliency. And so kind of being more specific, you have things like the lending practices and the collateralization for lending that has changed dramatically since the market implosions that happened a few years ago. A lot of the DeFi protocols that have been around for several years at this point are fairly battle-tested and seem to be fairly stable and are able to deploy significant upgrades without too much of a kind of a blip on the radar. And I think those are all indicative of a much more resilient market, a much more kind of structurally sound market over time. And it's the combination of all those things, individuals understanding their respective verticals and implementing best practices that lead to resiliency in the markets themselves. So while it's easy to say, the realized vol of Bitcoin has gone down kind of over time, I don't think that's the whole story. It's the sophistication and the maturation of the underlying infrastructure and risk management practices that have gone a long way to improving the resiliency over the past 5 to 10 years.
Mm-hmm. Is there something at this point 2025 that you could wish for, that you think could contribute to even more resiliency, more health in the market?
The easy answer is regulation, right?
Sure.
Like additional regulation and clarity around that, I think, goes a long way. But I think I want to flip it a little bit, right? We talk a lot about resiliency of crypto markets, but I think we also need to talk about the resiliency of TradFi markets. We spend a lot of time in our organization just trying to be a student of the markets and understanding why things happen and how you could try to fix them. And oftentimes, one of the biggest reasons for major market dislocations in TradFi is the inefficient management of collateral and margin calls. And so when we think about, what could continue to kind of proceed in a way to like improve resilience of the markets, one of the things that we're looking for is bringing the concept of tokenized collateral, 24/7 mobility of that collateral into the traditional markets. Because if you take the gilt crisis, for instance, if you were able to pledge tokenized gilts as collateral in real time, how quickly would that downward spiral have been short-circuited? If you are able to, say, tokenize a customer's assets appropriately, would the situation that MF had have taken place if that transparency and the smart contract controls for what you could do with that collateral were in place? And so it's really easy to say TradFi is perfect and DeFi needs to learn a few lessons from TradFi. But I think we're now at the point where TradFi can be learning some lessons from DeFi. And I think that's a really fascinating development over the course of the past few years.
It's really interesting. You obviously somebody who studied the markets for quite a few years with your background, DRW and Cumberland. It'd be interesting to take a step back in time, kind of 10 years ago when Cumberland got started in crypto. I know you were not there at the very, very beginning, but you came along soon after that. How was the thinking at this point when you get into this nascent crypto space? What are the considerations? What are the things that you need to do? And what are the opportunities that you look at? What are the theses that the Cumberland DRW had back then?
Yeah, that's a big question. I think the original, and like you said, I wasn't there on day one, but I think the original thesis was that digital assets, and particularly at the time Bitcoin, represent a fascinating innovation. And it could represent a new, more efficient store of value, a more efficient way to move value, potentially a more transparent way to understand kind of risk in a system. And as a result, early on, we thought it represented the first in what would be a series of very important innovations in capital markets. And so when we sat down, we kind of thought about where it went from, say, block zero in Bitcoin to where we are today. One of the primary theses was that not only will digital asset markets grow and likely take the shape of kind of the way the FX markets work, but it's just a matter of time before many of the existing TradFi assets become tokenized, and that many of the existing TradFi workflows start to get built on blockchain to kind of adopt and to leverage those innovations in a way that traditional markets just haven't been able to do so. Now, along the way, you learn a lot of lessons. Now, we were lucky enough that being part of DRW, many of those lessons had been learned, and we've been educated on market dynamics and risk management in a way that I think was kind of the cornerstone of the way we conduct our business. The idea being that you need to look at these markets as a very kind of dynamic thing. And while it's very easy to adopt and buy into a premise, it's also very important for you to kind of stay very true to risk management policies and procedures, stay very objective in that process. And from very early on, I think what we had the philosophy of was DRW's risk management was as effective in the TradFi side of things as they would be in the crypto side of things. Because while the technology is different, the core principles are similar. And so we should apply those principles in kind to the crypto space. Now, what we wanted to do was to supplement that with the expertise in kind of the nuance of what digital assets are. The concept of how you move assets from a blockchain, how you manage security around wallets, what settlement risk looks like when you're post-trade settling with a counterparty for a digital asset as opposed to something that goes through a clearing firm. All of these were important considerations for us. And what we've, I think, started with and continue to believe is important is that you need that specialization. You need a multidisciplinary approach to these markets, to risk management, to operations, in order to be as effective at the scale that we are as we'd like to be. And so right now where we're at is in a space where the market structure is rapidly evolving. More organizations are starting to participate in various different ways, but the core underlying premises are all still the same. There's some nuance to the technology, there's some nuance to the market structure, and you need to bring knowledgeable experts from every vertical in order to do this the right way. And so we'll continue to build on that.
So there was some thought at the beginning that this could develop into a market like we know in some other areas like FX, but also an interest in the technology, not necessarily an interest just in trading a very volatile asset where you can make a good amount of money.
Yeah, well, listen, like we're a trading firm, right?
Sure, okay, yeah, let's be honest.
Let's be honest, yeah, we're a trading firm, but we're also like genuinely inquisitive. And all the way from the top down to every individual that's working on this team, I think genuinely believes that there are very important innovations in digital assets that could help improve the way the traditional markets work. And so, while there was always a motivation to be a trading organization, there's also a motivation to be an innovative organization. Innovative in terms of building new capabilities, but also being a thought leader in the way the market structure will develop overall, lending our opinion to regulation, lending our opinion to those incumbents in the TradFI space that are trying to enter into the DeFi space. Because we genuinely believe that markets can be made better using these technologies. And we find that it's part of our responsibility to help that happen in a thoughtful and kind of compliant sort of way.
So on one hand, bringing the innovations of the technology to capital markets, but then, as you mentioned, risk management being kind of at the core of DRW's background, maybe also a tendency to say, well, we could professionalize these markets, we could bring big boy kind of ideas and practices to this market and position ourselves very well at the same time. Is that one thesis in a sense?
Yeah, and that was kind of the cornerstone of who we wanted to be, not only in the early days, but today as well. We felt the innovations here were an incredibly important step for capital markets. And in the early days, we kind of looked at the landscape and recognized that a lot of what was happening was going to be new for a number of these different traditional organizations. And when you think about markets, well, what do? What is the purpose? And I think one of the primary purposes is to subsidize the risk of people that have a reason to be participating in that space. And so when we think about how we could be the best counterparty in the OTC space, one of the first thoughts is, how do we make it clear that we are the compliant, thoughtful, conservative, kind of risk management-centric organization that a number of the other institutions that are looking to enter into the space want to participate in the markets with, want to trade with. And so, what we think is that is a critical foundation of everything that motivates us and drives us forward. And that continues to this day. Now, it just so happens that the types of businesses, the types of opportunities that are emerging continue to evolve and to grow. So what being the compliant, thoughtful, conservative organization in 2015 meant is, at its core, there's still kind of common things today, but it's different now because the landscape is much larger, and the types of activity is changing and evolving. But that's still the core of what we want to do.
And do you think at that point or in those early days there were things that you knew from traditional markets, processes, whether it's risk management or even operationally, trading-wise, that you say, well, we should take this from traditional markets and bring this into these markets, which will position us in that grown-up, conservative, compliant way, things that crypto needed to get from TradFi?
Yeah, dozens of them, right? Some big, some small. I would say one of the things that was most important for us is really building a sound risk management process around our counterparty-based trading. Another was really thinking carefully about what it meant to operate I'll call it a tokenized business on a 24/7 basis. After having spent the majority of our existence trading in a world in which you have central clearing parties, you have intermediaries helping to manage some of that counterparty risk, and you're moving cash and securities that are custodied by a third-party organization as opposed to moving these tokens and assets on your own. Mm-hmm. And so we thought a lot about how to take those concepts and principles and apply them to a different workflow and a different technology set. Beyond that, we think a lot about what it means to manage balance sheet appropriately, right? It's really easy to think about what the happy day scenarios look like. It's a lot more difficult to say, well, if these 5 things happen and there is a spike in volatility in the market, what is your plan? Mm-hmm. So you can't, if you're coming up with your plan when the event is happening, it's already too late. Mm-hmm. So you end up spending a lot of time preemptively thinking about scenarios that may never happen, so you have that plan when and if they do happen. And I think that was an important thing for us. It's really easy to get caught up in the opportunity as it emerges. It's difficult to stay very disciplined and to think very deeply about the what-if scenarios. So not only to avoid some of those what-if scenarios, but if they do emerge, your plan is already ready to go.
Mm-hmm. So you're mentioning counterparty risk several times there, and managing counterparties and positioning yourself as a reliable counterparty. I think you've commented some on events a few years ago where a certain counterparty, FTX, went down quite spectacularly. Were there conversations that you had maybe before that or around that time with people where you tried to encourage them to consider counterparties and counterparty risk, and what were kind of the reactions to this professionalization that you're trying to bring to the space?
It differs. It's a case-by-case thing. I think it's really easy to look back with hindsight being 20/20, right? And I'm not going to pretend like our vision is 20/20 all the time. And so I'm very careful to kind of look back on things and say, well, you should have done this or you should have done that. But I do think one of the lessons that we learned was that as much as it's easy to look for and rapidly deploy into opportunity, you need to do so thoughtfully. You need to do so with certain guardrails. And you need to do so within a structure that, in the event that your hypothesis is wrong, that you can manage the risk of whatever has taken place as a result of it. And so, I think, what really worked well for us was we were one of those thoughtful organizations. We were very kind of focused on making sure that we understood the nuanced risk of what we were doing, and made it clear to folks that these were our standards. Mm-hmm. Right? And sometimes organizations liked those standards and saw that as a reason to participate or to interact with us. And some organizations saw that and said, well, maybe there is an alternative to what you guys are doing that I'm going to go pursue anyways. Mm-hmm. A small anecdote, but I remember when we first started our bilateral options business and we were introducing ISDAs for these OTC bilateral options. And I don't know if we were the first to introduce ISDAs for these sorts of things. Probably weren't. But I do remember some of the reactions that we were getting were either, this is great, this is going to take some time to negotiate, but this is exactly what we want. And some of those reactions were, well, there's probably a quicker way to get this trade done. I have a time to market that matters, so I don't have time for an ISDA. I'm going to go trade with someone else. And at the end of the day, that's your call. But I do think that over time, those kind of standards like ISDA govern bilateral transactions are becoming more of the expected norm. And so, maybe we had to, put in a little bit of extra effort in the beginning, but now I think the market kind of expects that and is welcome to those sorts of frameworks to trade within.
So you would say we're getting to kind of a TradFI level of awareness around risk and counterparty risk and those things that can't be solved just with some better tool or better data set, but actual making conscious decisions, sometimes painful decisions about which business opportunities you go for and which ones not. Generally, you would say that's a positive development in the last few years.
Yeah, I think so. And I don't think it's just us, right? I think overall the market has done something similar. Mm-hmm. And if you look at kind of the composition of participants today, you have those that have been around for years, that have seen each phase of the evolution of the market structure and have kind of grown along with it. But then you have certain organizations that are just starting to participate in the marketplace, and they have certain standards that they require. And so I think it's kind of fascinating to see that new entrant effect on the existing entrants. Right? It's one thing for us to say we believe best practices are ABC. It's another thing for a new entrant in the market to come in and say, we can't participate until you do XYZ too. And so it's almost like those new entrants are pulling standards forward. And I think that's a positive development, right? It's at the end of the day, markets are a very dynamic and multifaceted thing. And the more perspective, the more best practices, the more kind of evolution towards optimal structures that takes place, I think the better. And anytime a new entrant joins, they help in that journey. And so I don't think this is a task that ever ends. I think this is just a natural effect of markets being Darwinian, and every new element, every new participant slightly changes the dynamic towards a new global maxima.
And are some of those new entrants coming into the market banks? I mean, they obviously have perhaps the highest standards of financial institutions or participants in the space. That's something that we think about at RULEMATCH, since we're never a counterparty, and the conversations we've had with participants is they don't want to be trading against an exchange, quasi-market maker, so on, but rather against other regulated counterparties. Do you think that is now a positive development that brings in more financial institutions at the highest level?
Yeah, absolutely. It certainly raises the standard, which means you need to do more work to meet that standard. But I think that's a good thing, right? I think if you believe in the long term, not only the digital asset market itself, but the applicability of the technology that underpins it to traditional markets, a raising of the standard, whether or not it's clarity around rules or expectations around best practices, those are all good things for the long-term health of the marketplace. Now, I mean, you asked, are these big institutions entering into the space? Well, I mean, yes. I mean, I'm not in a place where I should be naming names or anything, but take a look at BlackRock's ETF. Right? It has 70 billion of AUM right now. You compare that to GLD, which I would argue is kind of at least conceptually similar, which has somewhere a little bit north of 100 billion. And so this ETF, the BlackRock ETF, got that AUM in somewhere around a year's time. So does that push the market forward in terms of the ability to adopt it as an asset class? Yes. But it also, I think, brings additional participants into the space that maybe they could not have traded the underlying spot contract, but they can trade the ETF. They can trade the listed future on kind of like a US DCM. And as a result, those organizations start to think about what additional work can be done, what additional development can take place in order to continue to move the digital asset market forward, such that they could then go and participate in spot. So I think each one of these developments is kind of
a domino effect. It's a
good way to put it. A bit of a domino effect that raises the standard for everyone involved, and I think ultimately that's a good thing.
Definitely. Not, as you say, and I fully believe you, Cumberland has been focused on the risk aspect of participating in these markets from the beginning. Not that your risk appetite or your risk practices would have evolved, but maybe just the way you handle that risk, I can imagine, has evolved from the early days of the market when there were certain participants in the market to today. Can you speak to a little bit how maybe it has gotten easier to manage that risk, or it has gotten easier to work in different ways over time?
Well, I certainly get to sleep a little bit more today than I used to. Yeah, so that's good. Yeah. But I mean, I say that in jest. We're a 24/7 business, and we have an incredibly talented team that makes it so we can operate in a 24/7 space where people understand their responsibilities, people have the agency they need to in order to make sure that we are operating optimally at any given point in time. Now, that all said, I think there's been an evolution elsewhere in the market too, in that similar to us thinking about what the best practices are, thinking about how do we position ourselves in order to be in the right places, adoption continues. I think other major market participants are doing the same exact thing, whether or not it's on the trading side, on the exchange side, on the lending side, custody side, kind of all across the board. Now, these are very nuanced services, and I'm not going to pretend like I'm an expert in all of them. But what I've found is that each one in their own way has learned from the past. Each one in their own way is being pushed to continue to evolve as a result of new participants entering into the space. And so it's the kind of the way I describe it is it's a bit of like a kind of a staggered race. Like one vertical moves a little bit forward, and that unlocks the capability for another organization or another vertical to kind of increase their level of sophistication, and so on and so forth. So rather than having this kind of just kind of step
all or nothing.
Yeah, it's not really the stepwise all or nothing growth. It's more of like this incremental growth that sometimes happens across different verticals. And so I think we're on the lookout for every step that these organizations take. I think a good example was these kind of bankruptcy remote structures for custody offerings that developed in reaction to a lot of what happened with FTX. And so that's the kind of like maturation that we're talking about. Over time, people see what happens, build a solution to try to address that problem. It becomes codified, more adopted, and then people build services on top of it, and so the cycle continues.
The iteration continues.
Yeah.
And I think I've heard you talk about this before, kind of on that topic. People probably have now realized that this vertical integration of market structure is not necessarily a good thing, right? We see now more separation of duties, separation of roles, a recognition that maybe some things in TradFI markets are good from a risk management standpoint in crypto markets. How far are we on that road?
That's a very multifaceted question. I think what we're seeing now is the institutions that are active in the TradFI space thinking about how to bring those specific capabilities to the DeFi space. And in most cases, there is that kind of, I don't want to say single responsibility because sometimes it's more than single responsibility, but that specialization. And the overall workflow is a composition of many organizations executing their specialized service. And so the more we see those, I'll call it TradFi incumbents, try to apply their capabilities to the DeFi side, whether or not it's for, I'll call it crypto native assets, or if it's to utilize blockchain technology for TradFi assets, you are seeing this kind of growth of the specialization. Now, vertically integration, it's a thing. Whether or not it's the right thing ultimately, like I think there are some concerns, right? Inherent conflicts of interest, for instance, making sure that you have customer funds segregated appropriately. These are all very important topics. And what the final state of this is once there's a let's just call it a very diverse set of market participants. What that final state will be is anyone's guess. And my gut is that it'll be a little from A and a little bit from B. And maybe what ends up happening is you get these vertically integrated silos that start to offer some of those third-party services as part of their vertically integrated silo, almost as like kind of like a pick which one you want kind of offering. We'll see how it evolves over the course of the next 4 or 5 years.
Maybe with more participants, there's more competition, which in some ways breaks down the silos a little bit because somebody can specialize in something and do it better, and therefore, people prefer that service that's a little bit better, higher quality, cheaper, whatever.
Yeah. I mean, I think anything is possible there, and I think that's what's fascinating about these markets. As much as I think that it's important to have a diversification of service providers, and that specialization is a very important thing. It's certainly possible that people find value in a vertically integrated solution because it's easier. It's a one-stop shop. That's oftentimes one of the arguments for it. And so, just like I think the future is a multi-chain future, it's very possible that the future is kind of a multi. I don't even know what you would call it. a multi.
Multi-style.
Yeah, that's great. A multi-style approach to combining services versus a vertically integrated service. But what we've seen in TradFI is typically the diversification of service providers. Typically, is the choice people go for.
Looking just a little bit more specifically around trading, of course, DRW Cumberland is a proprietary trading firm, so your business is doing business, trading, making money in crypto. And different people have talked about how the market has changed and different opportunities have changed in the market. How do you see the changes in market structure changing? And I won't ask for any specifics around market strategies, but just the opportunities in general, whether it's arbitrage opportunities or things that an active trading firm looks at over the years.
Well, just to make my legal department happy real quick, none of what I say is investment advice, just my opinions. It's been a fascinating development, right? It's, when you think about what the crypto market was in 15, 16, 17 versus what it is today, I think the one word I would use to describe the difference is just diversification. In the earlier days, there weren't that many products. There weren't that many platforms. And so there were, I would say, a variety of opportunities, but it was not that... was not as dynamic and is not as varied as it is today. So what do I mean by that? Well, a common trade is a basis trade, right? And prior to the ETFs, the majority of the basis trades were really kind of futures versus spot, or maybe perps versus spot, or perps versus futures. But then you introduce ETFs, and so now you could have an entire segment of the marketplace that cannot trade spot, that is trading like an ETF versus future, ETF versus perp basis. You have organizations that are looking for ways to monetize their holdings in a way that doesn't make it so they need to sell those holdings. Maybe they're looking to write covered calls or something. You have organizations that still trade the arbitrage strategies. But what is arbitrage, right? There are a number of different ways that you could say value on one side is out of alignment with value on the other side. And the more participants that look to conduct those sorts of strategies, you'll start to see nuance develop. And maybe someone finds an arbitrage in just outright price. Maybe someone finds an arbitrage in kind of the cost it takes to fund the transaction. Maybe someone finds another element that they optimize for. And the same goes for liquidity providers, right? At the end of the day, I think the increase in market participants drives more nuanced and specialized strategies, which ultimately creates, going back to what we said earlier, a more resilient marketplace. The more strategies, the more motivations people have, the less likely it is, I think, for a dislocation to take place because everyone is acting in a similar way.
Mm-hmm. We have more smart people in the market with a self-interest of making money, of doing business, then you have more balance in one sense in the market. Yeah,
balance. That's a great way to put it. There's more balance, right? There's less groupthink, and I think that's ultimately a healthy development.
Talk to me just a little bit about how latency might play a part in the development of things. Crypto hasn't been super fast in the past, like traditional markets or FX. Where is it today, and could you wish for more opportunities there?
So I'm going to say something, and immediately it's going to be antiquated. But before I do that, I remember when we were first getting involved in latency-sensitive strategies, years ago in our TradFI business. And I vividly remember being in a conversation where someone said, we get, you could be down to, sub millisecond times, hundreds of microseconds. And my reaction was, why? Like, why do we need to go to microseconds, right? And then, what's next? Nanoseconds and femtoseconds? Like, hey, come on. Like, and I don't know, that comment had a shelf life of about 18 months. And very quickly,
everybody reminded you of it.
Yeah. I mean, it's, I've been wrong occasionally. But so, I think about that a lot, right? And, what drove that, I would call it that, constant optimization of latency. And I think deterministic, actions are important. And once you have determinism in your technology, all of a sudden, like, latency becomes more and more important ultimately, because that helps you reduce the uncertainty. Right? And I think, at least the way I think about things a lot is, what can we do to reduce uncertainty? Whether or not it's risk management, operations tech. And so there is inherent value in being able to move quicker, move in real time, because there's less uncertainty. And so when I first saw these estimates of sub-millisecond latencies, I kind of scoffed at it, but quickly you realize part of the value in improved performance is reducing that uncertainty. And anytime there's a technological leap that helps do so, it will get quickly adopted. And so what is latency sensitive today is very different than what was latency sensitive 15 years ago. And so I kind of think about it the same way in the crypto space. Now there's the common chorus of, well, these are internet-based or cloud-based platforms, so you're dealing with some of the latencies associated with that. But every time technology improves to enable better performance, the market will adopt it. That's just the way it's going to work. And then it will be hungry for the next innovation. And so if you ask me what latency-sensitive trading today is, well, there is latency-sensitive trading in DeFi, in crypto, but is constrained by the technological capabilities. And once that changes, we will now be in a new regime. And then that will change again and we'll be in a new regime. And so I very much think that over time, you'll see a continued march towards lower latencies, whether or not it's from transmission of information or matching at the exchanges. But it's, again, going to be another one of those kind of incremental steps over time.
Okay. We're helping on that as well. On the side of the actual trading, we've had pre-funding in crypto trading for a long time. I think I'm correct in saying that's not something that you necessarily like at Cumberland and that you try to avoid. Talk to me about why and why that also helps to reduce uncertainty, or where that figures in the overall picture.
So just to be clear, we do not accept pre-funding at all. And I can understand why someone would hear that and say, well, that increases uncertainty, correct? And our stance typically is that, one, we think pre-funding is not economically efficient. Right? Imagine a scenario in which you had to post $100 million to a platform in the hopes that you would trade $100 million worth of digital assets in a day. And at the end of the day, you find you only transacted 20 million. Well, it's this 80 million worth of capital that is effectively just dead capital, and you're paying carry on that. Not only carry on that, but it's loss of optionality too, because we couldn't deploy it elsewhere. Another element of this is kind of the counterparty risk, right? If a counterparty had to post pre-trade value to us, well, now we're a service provider to them, and now they have counterparty risk to us holding their assets when they may not necessarily have a need to transact at this exact moment. And so, what we found is between the capital efficiency and the risk reduction of someone else taking counterparty risk to us, it's a much preferable structure to allow people to come whenever they would like to trade and quote. And then if we decide to consummate a transaction, to settle that post-trade. Now, there's counterparty risk there on that post-trade settlement side as well, but that seems to be, I think, a more manageable and acceptable type of risk for us and our counterparties than this pre-funding. Also, I think people really appreciate the fact that it's just significantly more capital efficient.
And when you're settling those trades, that is at set times, or is that flexible? Is that Cumberland is always sending first or receiving first, or is that a flexible setup?
There's some flexibility to the setup. I think at the end of the day, the way we think about it is, what is the optimal configuration of kind of risk management coupled with counterparty experience, coupled with capital efficiency. And I'm sure my ops department would really like to just say, okay, we're only ever going to settle at these specific times during the day because it's a little more structured. But as the market more and more demands the ability to kind of settle in real time or on demand, ultimately I think that will become more of a standard industry-wide. And I don't think that's just in terms of counterparty-based transactions. I think that's really in terms of any sort of value movement. Getting back to the comment I made earlier about reducing uncertainty. Well, what is one of the easiest ways to reduce uncertainty when you're conducting a bilateral transaction? Well, instantaneous settlement potentially. And things like stablecoins or even Bitcoin, for that instance, lend themselves very well to near instantaneous settlement. And I think that ultimately will transcend crypto native markets. We talk a little bit about earlier, and I'm sure I'll talk later about this concept of collateral mobility in 24/7. If you are able to make a margin call in real time on the weekends, how powerful of a tool is that for managing things like counterparty risk? And so, ultimately, I think as much as people believe there's a lot of steps that need to take place between now and then, I think even you're going to start to see VM settled near instantaneously. And it'll all be via automated mechanisms, potentially smart contracts that have the specific characteristics of the margin that you're managing at the time programmed into it, and then just affecting those settlements on demand. That's kind of the terminal case in all this. A lot of work to be done between here and now to build it, but I absolutely believe that that's where this will land.
Chris Zuehlke, thank you very much for joining RULEMATCH Spot On. It's been a pleasure. Thank you very much.
Yeah, thank you. I had a lot of fun. Thanks for having me on.